overall, the rally has room to run because you think investor positioning remains defensive and light. So it's not, with all these moves since the beginning of the year, it's not embraced yet.
No, so I think the temptation is to say with S&P almost back to its all-time highs that investors have gotten back into the market, and that's absolutely not what we're seeing. So among institutional investors, particularly hedge funds, we're actually seeing people add to shorts rather than longs in this market, and overall levels of gross exposure is far below what we saw at the peak last year, right? And you can see in terms of hedge fund returns, average return this year up 6 to 7%, with S&P double that. So it tells you people are trailing the market, there's still cash on the sidelines, and there's still room to go on the upside, I think.
I mean, the people lowered their S&P targets. All the people that were at 2950 went to 2750, and now they're caught. Now they're caught at 2750. So
yeah, so I think our house view is at 30.25 for year end. So we're fairly constructive just because our view on economic fundamentals.
30.25.
Yeah, that's our house view.
When you're saying that hedge funds though are adding to shorts, and you're taking a look at puts and calls,
yes,
which is what you do.
Yeah.
I mean, how do you interpret that as adding to shorts versus hedging a long position?
Yeah, that's a great question. So one of the things that we've noticed is that there just hasn't been that demand for protection this year. And I think, one interpretation is that people are very complacent, but I think it's more a factor that they just haven't added to exposures, right? They haven't added to their stock exposures, therefore they don't have the need to hedge. So until we see that gross exposure level really going up, we expect still fairly muted demand for protection.
Tyler, Michael, you take us to emerging markets in China, and then Mandy can chime in because I think she's also bullish.
Yeah, there was a lot of fear last December and into early this year that China was slowing down fast, that they had way too much debt, especially at the state-owned enterprises, and that they were going to come to a screeching halt, or at least to a substantial slowdown. And that took a lot of emerging markets money out, in addition to which there was some concern about the dollar getting too strong as the Fed was continuing to talk hikes, and that would have also hurt emerging markets. So now look what happened in just the last couple of months. The Fed pivots to a more dovish tone. That's great for emerging markets. And the latest news out of China, manufacturing numbers and so on, are all looking like they're beginning to turn it around and begin to reaccelerate a little bit. And of course, if we get a trade deal with China, that's a big plus as well. So all of that says that China is working right now. China, also MSCI, has made China a larger portion of its emerging markets indexes. That's driving the entire emerging market space. So I think that still has some room to run.
How close are the emerging markets to recouping what they lost at the end of last year? Mike?
I think they're not quite there, but they're getting pretty close. And that's why I think they still have some good room to run. They can take out the highs from last year and continue going. The valuations are quite reasonable.
You agree?
Yeah, so we're constructive. I think what's interesting is in the options market, all the flow has been on the bullish side. And not just that, we're seeing outsized option activity. So one of the things we want to highlight is if you look at the A-share ETF, which tracks the Chinese domestic market, we're seeing about 7 times the usual volumes this year versus last year. And more importantly, it's all on the call side. So we're actually seeing calls trade more expensive than puts, which is very, very rare for equity indices. So that gives you a sense of kind of the bullishness out there in the market.
And more so in the A-shares ETF versus the EEM ETF?
Exactly, yeah. So I mean, it makes sense because A-share is up, I think 38% year to date versus EEM, right, which is in the low teens. So that kind of gives you a sense. Within emerging market, China is where you want to be.
Right.
So, Michael, in terms of fixed income exposure, you're back to treasuries away from corporates because spreads have collapsed. Does that mean recession fears are going away?
Comes back to what Mandy said. There is some complacency in the market, and you're seeing that in fixed income too, where the fixed income market is telling us that although they expect the Fed to cut rates, which I don't believe, by the way, they also think the economy is strong enough that there's really not a lot of risk in corporate credit. And as a result, spreads are tight, and we're not being paid to take risks. So if I'm not being paid to take a corporate risk, I'm going to shift some of my exposure to treasuries.
Mandy, I mean, what derivatives do you have for us for fixed income?
So not fixed income, but tying to that with credit spreads back to the tight.
Right.
What's interesting is within equities, small cap equities have really trailed this rally, right?
They're in correction territory right now.
Exactly. So I think they're down. I think they're lagging the S&P by over 10%. So we're looking at upside in IWM, Russell 2000 index, as a function of lower rates and credit spreads tightening and overall improvement in the economic condition.
Tyler, you're not as bullish on the S&P, I guess. You don't think 3,000? Do we hit it and not stay there, or what?
We may touch it. We may even go past it. But I think by the time the year is out, I'll be happy if we get to around 2950 or so. One of the key things is that guidance at the end of the fourth quarter, January time, the fourth quarter earnings reports were really muted. And a lot of people are now expecting that we're going to see much better guidance coming out of the first quarter earnings, which, of course, start on Friday and continue through the next few weeks. If it turns out that way, I'll be thrilled, and then I can raise my target. But for right now, I have to be a little bit more cautious. You
think we have a down quarter in the first quarter with the overall S&P earnings, Michael?
Yeah, we could. It's going to be pretty close to zero, a couple percent either way. And coming from 25% on the upside in the third quarter last year, and I think 14% in the fourth quarter last year, that's a really fast slowdown. And what we can hope is that that's a function of slowing economy, which we saw in a lot of factors. The government shutdown certainly had an effect. And maybe by the time we get into the second quarter, we're starting to see the more macro numbers picking up. Mm-hmm. So I think we should see a pickup in earnings as we go through the rest of this year.
We're just getting an upgrade from JP Morgan. Pulte Homes and KB Homes going to a neutral from an underperform here. Mandy, you like XHB?
Yes, the home builder.
And you're saying a risk reversal, basically.
Yeah, so what we're noticing is there's still a lot of downside being priced into the sector, so puts are trading a very high premium relative to calls. So if you're constructive on the sector, selling puts to buy calls in XHB looks to be an attractive trade in derivatives market right now.